This is Trade Alive with IUX, where markets come alive and trading gets real. Let's go live.
This podcast is brought to you by IUX Trading Platform, elevating your trading experience.
Within the financial markets, there is a fundamental paradox that has challenged traditional logic for decades. Ask yourself this question: why do individuals from various professional backgrounds, structural engineers, high-level corporate attorneys, or even specialized medical doctors, still face catastrophic failure and financial losses when entering the financial arena? The answer to this phenomenon is not a lack of deep analytical data, nor is it the use of inferior computational tools compared to massive financial institutions. Some market commentators believe behavioral factors may influence trading decisions. To decode this structural flaw, we must examine an individual who did not begin his professional trajectory as a Wall Street fund manager or a quantitative financial analyst. His name is Alexander Elder. Alexander Elder incorporated concepts from psychology into his market analysis approach to surgically analyze mass market behavior. He does not view the market merely as fluctuating numerical data on a screen. He has described markets through a behavioral finance perspective. The core operational principle Elder discovered, which fundamentally restructured the trading industry, is profound. A trading framework he developed and discussed in his publications will rapidly and permanently collapse if it is operated by a fragile, undisciplined mind. In the realm of professional capital management, Elder argued that psychology may play an important role in trading discipline. Develop disciplined decision-making processes. Before you even attempt to manage your capital, welcome to Trader's Journey, a part of Trade Alive, brought to you by IUX Education. In this episode, we invite you into the office of Wall Street's premier psychiatrist. We will discuss behavioral concepts commonly referenced by traders and explore concepts used by some experienced market participants. This is the psychiatrist of Wall Street, Alexander Elder's views on trading psychology. Prepare for your clinical diagnosis. To understand the psychological framework that Alexander Elder built, we must first examine the intense crucible of his past. His journey to Wall Street did not begin in an Ivy League financial program. It began with a daring escape for survival. Born in the Soviet Union, Elder served as a ship's doctor. During a voyage docking in Africa, he made a life-altering decision. He leaped from a Soviet vessel, evading authorities to seek political asylum in the United States. Arriving in America with virtually nothing, he systematically rebuilt his entire life, eventually establishing a highly respected practice as a psychiatrist in New York City. Alexander Elder, known to many as often referred to as the Psychiatrist of Wall Street, is a clinical psychiatrist who popularized behavioral and psychological concepts among traders. And it was this exact medical background that gave him an unmatched advantage when he finally directed his attention toward financial charts. When Elder transitioned into the financial markets, he did not view price action the way standard retail analysts did. Where traditional investors saw mere trend lines, mathematical indicators, and chaotic numerical fluctuations, Elder applied his clinical lens. Looking deeply into the charts, he recognized familiar human behavioral patterns. He deduced that the stock market is not simply an economic machine. It is, in reality, an environment influenced by collective market behavior. Every surge in volume, every rapid price acceleration, and every violent market crash was merely a visual representation of millions of individuals reacting to collective panic or euphoria. Through this clinical observation, Elder arrived at a profound realization. He began to diagnose the average retail investor, noting that the vast majority exhibited recurring behavioral mistakes. Even when equipped with a statistically sound trading methodology, these individuals continuously sabotaged their own capital. They consistently allowed the primal emotions of fear and greed to override their logical execution protocols. They held on to deteriorating assets due to blind hope and prematurely liquidated profitable positions out of irrational panic. Elder recognized that this was not a financial problem. It was a clinical one. He concluded that in order to survive the markets, traders did not need another complex indicator. What they urgently required was a rigorous psychological framework, a structured framework designed to override human emotion and help them manage behavioral biases. Alexander Elder developed a structured trading framework that explores the relationship between trading psychology, market analysis, and risk management. He believed that behavioral awareness alone may not be sufficient and advocated combining psychology with structured trading rules. This framework is one of the concepts discussed in his educational materials. For financial survival, the three pillars architecture, or simply the 3 M's, Elder compares this operational framework to a three-legged stool. In structural engineering, the concept is absolute. If even a single leg fractures under pressure, the entire structure instantaneously collapses. Elder drew parallels between this concept and the discipline of trading. Neglecting one aspect of the framework may increase trading risk and affect decision-making. The first and fundamentally most critical pillar is mind. This represents the trader's internal psychological infrastructure. Elder emphasized that disciplined decision-making is an important component of trading. An individual must maintain absolute clinical discipline. This requires managing emotional influences during decision-making. A professional does not trade to prove they are right, nor do they trade for emotional excitement. The framework encourages traders to understand the role emotions may play during trading decisions. Where possible, Elder suggested that traders may benefit from viewing losses as part of the trading process or an attack on your intellect, but merely as a standard calculated business expense. Once the psychological foundation is secured, we move to the second pillar, method. This is the analytical engine of the entire operation. Elder emphasizes that you cannot navigate the financial markets relying on intuition, subjective feelings, or chaotic news cycles. The method requires deploying a strictly logical, mathematically driven system to analyze market data. It involves constructing a rigorous set of technical rules designed specifically to identify entry and exit points that offer a definitive statistical advantage. It is intended to provide a structured approach for analyzing market conditions, and equally important when conditions dictate that you must remain safely on the sidelines. Finally, we arrive at the third, and tragically the most neglected pillar, money. This is the rigorous application of capital management. Elder describes this pillar as a risk management framework. Even if you possess a flawlessly disciplined mind and a highly sophisticated analytical method, consecutive drawdowns are an unavoidable statistical certainty in the financial markets. The money pillar is a strict set of defensive rules designed to fiercely protect your cash flow. It focuses on the role of risk management within his educational framework during periods of market volatility. To truly operationalize the second pillar of his architecture, the method, Alexander Elder developed a technical analysis framework that remains widely discussed among traders. He named this engine the triple screen trading system. Many retail traders focus on a limited number of market factors. They hyper-focus on a single time frame, making them highly susceptible to market noise and emotional impulses. Elder's methodology encourages traders to take a broader analytical view and conduct a rigorous, multidimensional audit of the market before a single dollar of capital is ever deployed. To explain the intricate mechanics of this system, Elder elegantly compares market timeframes to the fluid dynamics of the ocean. The system mandates that every potential operation must successfully pass through three distinct diagnostic screens. The first screen analyzes the tide. This represents the macroeconomic structure, typically utilizing a long-term time frame, such as a weekly chart. The primary objective is to identify the primary direction of massive institutional capital. You do not argue with the macroeconomic tide. If the institutional tide is flowing upward, the framework generally discourages you from initiating any short positions. It may help establish a directional preference. Once the primary institutional direction is established, the data is filtered through the second screen, which analyzes the wave. This screen zooms into an intermediate time frame, such as a daily chart, specifically hunting for structural pullbacks or microcorrections moving against the primary tide. This is where Elder's clinical psychology background is brilliantly applied. When an asset experiences a temporary drop during a major uptrend, amateur retail investors often succumb to emotional panic and hastily liquidate their positions. The second screen is intended to help identify potential areas of market interest. It allows the professional operator to methodically position themselves against the panicked masses, identifying potential trading opportunities during periods of market movement. Finally, the operation is filtered through the third screen, representing the ripple. This is the micro-level assessment where the exact mathematical trigger is defined. It is not an indicator, but a precise execution technique. Once the institutional tide and the counter-trend wave are perfectly aligned, the third screen may be used to describe principles relating to risk management within his methodology. The ultimate logic behind the triple screen system is deeply rooted in Elder's psychiatric background. This framework is explicitly designed to function as a strict diagnostic protocol. By forcing the operator to analyze multiple timeframes and pass objective sequential criteria, it completely neutralizes impulsive emotion-driven decisions. Just as a medical professional would never perform surgery without conducting a comprehensive series of diagnostic tests, the framework discusses an approach to analyzing market behavior and trading discipline. Even if a trader follows a disciplined approach and applies the triple screen system consistently, they must accept a harsh mathematical reality. Losses are statistically unavoidable. The financial markets are an environment of probabilities, not absolute certainties. This brings us to the third and final pillar of Alexander Elder's architecture: money. Elder viewed money management as an important risk management framework that describes principles relating to risk management within his methodology. To operationalize this defense, Elder introduced two risk management principles that are frequently discussed among traders: the 2% and 6% rules. The first parameter, known as the 2% rule, suggests limiting exposure on individual trades. An operator must calculate their entry and stop-loss levels so meticulously that the rule is intended to help limit losses to approximately 2% under normal market conditions. The second parameter is the 6% rule, which serves as an additional risk management guideline. The framework recommends pausing trading activity if portfolio losses reach 6% within a month. The framework suggests reducing or suspending trading activity for reassessment. To an outsider, these parameters might appear to be nothing more than conservative mathematical formulas. However, looking through Elder's clinical lens, The 2% and 6% rules are intended to support disciplined risk management. Elder believed that consecutive losses may affect a trader's emotional decision-making. A series of losses may influence trader confidence and decision-making, leading to irrational behavior, aggressive revenge trading, and ultimately, account destruction. Elder described the 6% rule as a mechanism to encourage reassessment after losses. It acts as a surgical tourniquet, helping traders step back and review their approach. Elder described themselves, the 2% rule is forcing the trader to step away from the screens before their psychological flaw can destroy their financial foundation. By enforcing these clinical parameters, Elder completely fundamentally restructures how the operator perceives a financial loss. Amateurs internalize a stop-loss execution as a personal failure or a painful defeat. Some traders who follow Elder's methodology may view losses differently. He encouraged traders to view controlled losses as part of the trading process. Just as a retail store must pay for electricity and inventory shrinkage to remain operational, a professional trader must pay the market in the form of controlled losses to secure the opportunity for larger gains. This discipline is intended to discuss portfolio risk management concepts, supporting a disciplined approach to risk management over time. Alexander Elder is widely known for his book, Trading for a Living. This publication presents Elder's views on trading psychology, analysis, and risk management. Over the past few decades, this architectural framework has influenced many traders worldwide, who previously operated based on emotional impulses by encouraging structured trading practices. Elder argued that long-term participation may benefit from disciplined risk management and may involve developing disciplined decision-making habits. As we conclude this clinical audit of your trading business, you must confront a critical operational question. How do emotions influence your trading decisions? Are you ready to stop sabotaging your own capital? Allow the psychiatrist of Wall Street to systematically fix your flawed mindset, and finally develop a more structured trading approach. Take a moment to evaluate your own psychological flaws. Let us know in the comments which of the 3 M's you currently struggle with the most, and how you plan to repair your foundation. If you are genuinely prepared to continue exploring different educational perspectives on trading psychology and market analysis, your next strategic destination is the IUX website. We provide the premium educational infrastructure you need to deeply study the architectural framework of the 3 M's. Learn more about Alexander Elder's educational concepts on trading psychology, market analysis, and risk management. Before we conclude our session, we must highlight a strict operational reality. We emphasize that trading and investing always involve significant risk of capital loss. Elder systems are educational frameworks, not guarantees of profitability. Always operate within your defined risk parameters and rigorously protect your capital. Thank you for joining this discussion on trading psychology and risk management. This has been Trader's Journey, a part of Trade Alive, brought to you by IUX Education. Remember, trading frameworks should be supported by disciplined decision-making and appropriate risk management. Continue learning about trading psychology and risk management as part of your trading education.
You've been listening to Trade Alive with IUX. Ready to put these insights into action? IUX is here to power your next winning trade.